Good morning, everyone, and welcome. I'm Shalu Kara, one of the wealth planners here at Arbuthnot Latham. Thanks so much for joining us, and it's great to see so many of you returning for the sequel today.
And I'm Rachel Wyatt, also a wealth planner. And over the next half hour, we're going to look at key changes happening around inheritance tax and bring planning concepts to life, sharing with you steps other clients have taken to protect their wealth from inheritance tax. We have 3 very different client scenarios to take you through to give you some insight into the ways we have helped some of our clients achieve their legacy goals. We've also some useful hints and tips on the key actions worth considering as you approach the end of the tax year, so you can make the most of the available allowances and opportunities. And before we close, we'll take your questions, whether it's more information on something we've covered today or other planning considerations you would like to know more about.
Feel free to send questions through the Q&A function as we go. We'll receive them. We'll answer as many as we can at the end. And of course, today's session is to give you general concepts to consider and should not be treated as a personal recommendation. If you're new to Arbuthnot Latham, we are an award-winning bank with a heritage dating back to 1833. We put relationships at the core of what we do. Every client has a dedicated banker, supported by investment and planning specialists, making sure we really understand what matters to you, whether that's supporting your business, building up and protecting your wealth, or passing it on to your family.
And if you're joining us today and aren't already a client, but have deposits, borrowing, or investments of £750,000 or more, we'd be delighted to explore how we can support you. We'll share our contact details at the end of the webinar, so please get in touch. So Shalu, shall we start by taking first a quick step back to how the inheritance tax landscape has changed?
Yes, thanks, Rachel. Because regardless of wealth levels, everyone starts with the same core allowances. You have the nil rates band, which is £325,000. That's the amount each individual can leave without paying inheritance tax. Then, for those leaving their main residence home to direct descendants, there's the residence nil rates band of up to £175,000, although this tapers away once your estate exceeds £2 million. And you can transfer any unused allowance to your spouse or civil partner.
So these are your core inheritance tax allowances, and they've been frozen until 2031. Now, freezing allowances combined with rising asset values creates a stealth tax. More of your estate becomes taxable simply because the thresholds don't move with inflation. It's something many clients don't realise until they see the numbers. But had the nil rate band increased with inflation, it would now be worth £566,000.
Transfers to your surviving spouse are exempt, and generally, gifts made more than 7 years before death are also outside of your estate for the tax calculation. However, a major shift is coming in April 2027. Residual pension funds will now be included as part of your estate and therefore could be subject to inheritance tax. Historically, pensions have been a very tax-efficient way to pass on wealth. And pension contributions continue to receive income tax relief, and the investments grow free of income and capital gains tax. And therefore they are an effective way of saving for your retirement, and still an effective way of leaving a legacy up until 2027. So for many of our clients, pensions did become the leave until last pot because of this.
But as you mentioned, Shalu, from 2027 that changes. Pension funds will become part of your taxable estate for inheritance tax. And this is making people rethink how pensions can be used to meet their lifetime and legacy needs. It's not just the inheritance tax, but the tax treatment when the pension funds are distributed that is making people review their current strategies. Depending on your age when you die, the tax treatment will differ. So after age 75, the pension fund will not only face a potential inheritance tax, but your family will also pay income tax at their marginal rates when they receive the funds. So for higher and additional rate taxpayers, that could mean more than 2/3 of the pension is ultimately lost to tax.
There are also changes for business owners and farmers. From April 2026, there will be a combined business and agricultural relief allowance of £2.5 million that receives full inheritance tax relief. Any unused allowance can be used by the surviving spouse. Anything above this allowance will receive 50% relief. Shares on the alternative investment market sit outside this allowance, and relief is available at 50%, reduced from the previous 100%. Whilst this is certainly more generous than earlier proposals, for many it still presents a significant challenge to succession planning. And finally, inheritance tax has moved from a domicile-based to a residency-based assessment, though this falls outside of today's session. If anyone thinks this may apply to them, we'd strongly recommend speaking to a tax advisor.
Now we go into more detail about how inheritance tax is calculated and the changing landscape in our September webinar from last year. And this is available on our website, but broadly, allowances are frozen until 2031. Residual pension funds lose their long-held inheritance tax protection from April 2027, and business and agricultural relief is changing. With more estates expected to be caught in the inheritance tax net, now is the time to take a holistic look at your finances and review how you can best fund your retirement, how you pass on your wealth to future generations, and whether the current investment strategy you have for certain pots is still suitable. Put simply, proactive planning has never been more important.
So let's look at how we have been supporting our clients in response to this. Our first client is a great example of how simple steps taken early can have a transformational impact over time. We have a couple in their late 50s, both aged 58, with 2 adult children. They'd built up significant wealth across property, investments, private equity, and pensions, and in total, their estate is worth over £14 million. They'd sold part of their business in 2017, and after reviewing their finances, they realised something many successful families eventually see. They had far more than they would ever need in their own lifetime.
So the clients wanted to start passing wealth on, but they wanted this to be in a thoughtful and controlled way. They cared deeply about supporting their children, and they recognised the risks of giving too much too soon. Their children were still gaining financial experience, and they wanted any support to help them, not overwhelm them. They wanted to put in place a structure that would allow them to support their children and future generations too, but they didn't want to give up control and oversight.
So, what was the challenge? It came down to balancing 3 things. Number 1, control. They wanted to choose when the children received the money and how it was used. For example, when the children were ready to step on the property ladder, or to provide financial support when they started their own families. Number 2, protection, making sure the children weren't exposed to large sums before they were ready. And number 3, longer term planning, creating a structure that would grow outside their estate, reducing inheritance tax for decades to come.
So what we recommended was a very simple but powerful approach, and something they could build into the rhythm of their long-term planning, using their nil rate bands to fund discretionary trusts on a regular cycle. A trust is a separate legal entity that you can use to hold assets on behalf of others. When you place assets into a trust, you decide how much interest in the gift you are giving up. In other words, you choose whether you keep a lifetime right to the benefit from the assets or whether or not you give them away entirely. This determines how the trust works for you and how the assets are treated for inheritance tax purposes. So, for example, you could set up a trust to give you a regular fixed payment. Any surplus capital to meet this obligation is treated as a gift, and any investment growth is outside of your estate. Or you could lend money to the trust, keeping the right to get your loan back whenever you want, but any growth on the funds sits outside your estate. Or you can make an absolute gift, giving away your full interest in the capital, as well as any future growth, removing both from your estate permanently. You appoint trustees, which could be you, then hold the funds on behalf of the nominated beneficiaries, which can be a named individual or a class of beneficiaries such as children or grandchildren. Now, this couple were comfortable giving up all interest in the gifted money, and they wanted to retain flexibility on who could benefit from the gift.
In 2018, they each placed £325,000 into discretionary trust, keeping options open over who could benefit and appointing themselves as trustees. This allowed them to keep control over how the funds were managed. While the gifts are outside the estate immediately, they are still considered for inheritance tax purposes up to 7 and potentially up to 14 years after leaving the estate. Any growth on these gifted assets is out of the estate from day one. Fast forward 7 years to 2025, and those original gifts are now completely outside their estate. We revisited their bespoke cash flow modelling, which illustrated that there was capacity to make further gifts without there being any risk to their own lifetime needs. So we advised that they repeat the strategy, resulting in another £650,000 being transferred into discretionary trusts. So the rhythm becomes every 7 years, the clients move £650,000 into trust. All future growth is free of inheritance tax and control is retained.
The impact of this planning has been significant. The first trust, which invested in our globally diversified portfolio, is now valued at 1.15 million. And as the gift was made over 7 years ago, this is entirely out of their taxable estate. The more recent trust, set up last year, has already benefited from £42,000 of growth, which sits entirely outside of the client's estate. And after 7 years, that original £650,000 gift will also drop outside their estate. The clients have a rolling framework that passes on wealth efficiently, protects future growth from inheritance tax, and keeps them firmly in control. At a later date, the clients want to add the children as co-trustees, and this provides the children a safe and controlled introduction to managing the family assets.
And that's an important point to highlight, Rachel. Estate planning isn't just about tax. For these clients, it's also about preparing the next generation, giving them exposure, building their financial confidence, and helping them become responsible stewards of family wealth. Rachel, shall we move on to case study 2?
Yes. So our second case study focuses on a common concern amongst our clients: how to protect pension savings from double taxation under the new rules. So this is a client who is a 75-year-old retired doctor, recently divorced. His state and NHS pension gives him a secured income, plus he receives additional royalties from medical patents. He has a £1 million personal pension that he hasn't yet touched, an investment portfolio, and his main residence. Now, having made substantial gifts in the past to his 3 children, his long-standing plan has been to spend non-pension assets first, leaving his pension as a fund of last resort on the basis it could be left to benefit his children and grandchildren tax efficiently.
On the left-hand side of the screen, we can see that under current legislation, the client has his available allowances and the pension is out of the estate for the purposes of inheritance tax. But from April 2027, including the pension, his estate is valued at 2.95 million. From April 2027, the inclusion of the pension will take his estate above the £2 million threshold for the residence nil rate band. Now, not only will his pension be taxed, but with an estate of over 2.35 million, he has fully lost his residence nil rate band and only has the £325,000 allowance before tax becomes payable. Under the new rules, his pension, which was once his most tax-efficient asset, is now the most heavily taxed. If he were to pass away, the £1 million pension would now be subject to 40% inheritance tax. And because he is over 75, any withdrawals made by his children would also be taxed as income at their marginal rates, which for his children are 40% and 45%. Therefore, leaving around £330,000 to £360,000 available to split between 3 children. HMRC has become the biggest beneficiary of his pension, and what he hoped would be a meaningful legacy has now been significantly reduced.
Now, whilst the client had been comfortable making gifts to his children in the past, following a recent health scare, he no longer felt comfortable relying on the 7 years survive gifting rule. He was also reluctant to give up his lifetime access to his capital, so he needed a strategy that provided inheritance tax benefits quickly, didn't require giving up access or control over his savings, and reduced the double taxation risk of leaving the funds in the pension. What did we do, Shalu?
So we tackled the challenge by taking the following steps. The client can withdraw 25% tax-free from the pension as part of his lump sum entitlement. As he is 75, if he doesn't take this in his lifetime, it will become taxable when his children inherit it. To preserve this benefit, we recommended that he take the full £250,000 tax-free cash and reinvest it into business relief qualifying investments. After 2 years, the investment can claim 100% inheritance tax relief. To cover the 2-year qualifying period, we also arranged short-term life cover, so the £250,000 is protected immediately, even before the relief applies.
And just this step alone has immediately increased the amount that could be left to his children by over £165,000 over leaving it in the pension. We also identified our doctor had headroom within his 40% marginal rate band. One often overlooked planning opportunity is using gifts from surplus income. Provided they meet the criteria for regular and sustainable giving, these gifts are immediately exempt from inheritance tax. So we recommended he draw additional pension income, not because he needed it for spending, but to create a surplus which he could give away under this exemption. This eliminated the risk from double taxation on these funds. Now, his children were already financially secure, so he wanted to focus instead on building a legacy for his grandchildren. We recommended he establish a discretionary trust to receive the surplus income. This allowed him to build that legacy tax efficiently, which could then be used for future needs, things like education costs, help with the first home, or supporting other life milestones. Importantly, by using a discretionary trust, he avoided the risk of solving his own inheritance tax challenge only to create one for his children. Already having significant assets of their own, the trust kept the funds outside of the children's estates and also prevented the grandchildren from gaining unrestricted access once they turned 18, giving him a solution that went beyond his own potential liability.
The result? The £250,000 tax-free cash entitlement has been used and will fully benefit from 100% inheritance tax relief after 2 years. Life cover protects the value against any inheritance tax that could become due in the interim. Ongoing pension withdrawals and gifting this income away will reduce the taxable estate and over time may even reinstate some of the residence nil rate band. The amount of the client's estate at risk of double taxation has been reduced. This case shows how even when there is less confidence around life expectancy, well thought out planning can make a material difference to the outcome. And on to our last case study now.
Yes, so this case study considers a very different challenge and one we often see with clients who hold a significant value in illiquid assets, particularly property portfolios. Now we have a couple here in their mid-60s with 2 children in their 20s. An estate is worth about 6.3 million and includes a large property portfolio held within a limited company, cash reserves and 3 existing loan trusts. Their potential inheritance tax bill is about £2 million.
Now, these clients have already taken steps to manage their estate. They have set up loan trusts and were working further with their accountant to redirect future growth in the property company to their children. But the clients were concerned about how to raise liquidity to pay the inheritance tax bill. Selling property at short notice can be costly, and there are tax implications on subsequently drawing that cash from the company.
And so we needed a solution that would provide access to cash to pay the inheritance tax bill without forcing a sale of property assets or disrupting their existing planning. Shalu, what did we recommend?
Our solution was straightforward. We recommended joint life second death cover to pay out after both parents had passed away and when inheritance tax becomes due. We arranged £2 million of cover split into 4 separate policies of £500,000 each. This would give the clients flexibility. As their estate planning evolves, such as when clients move more assets out of their estate, they can reduce or cancel individual policies, leaving only the cover they still require in place, negating the need to take out any new policies when health may have changed, or paying for cover in excess of what they need.
And an important aspect of this planning was for these policies to be placed into discretionary trust. This means the insurance payout won't form part of their estate and won't be subject to inheritance tax. The money goes straight to the children, quickly and efficiently, exactly when they'll need it.
And this was a huge relief for the clients. They had spent decades building their property portfolio as a long-term legacy. They wanted it to stay intact and to continue supporting future generations. They didn't want their children to be forced into rushed decisions or fire sales at a difficult emotional time. By taking our advice, the children will receive £2 million immediately. The property portfolio does not need to be liquidated to pay a tax liability. It sits alongside their existing planning, and as future planning evolves, it is flexible.
And I think it's fair to say, wouldn't you agree, Shalu, that following our recommendations, it gave our clients a confidence that they didn't have before. Confidence that their children wouldn't be burdened, a confidence that their planning worked harmoniously, and a confidence that the legacy that they built would pass on in the way in which they wished. Now, these are just a few examples of the work we've carried out with clients. In every case, the advice has been shaped around their individual goals and circumstances. It's never a one-size-fits-all approach. So if you'd like guidance that reflects your own objectives, we'd be happy to help.
Let's finish up with some practical actions that you can still take before the end of the tax year. These are simple steps, but they can make a meaningful difference over time. You can put up to £20,000 into an ISA, and between a couple, that's £40,000. Or returns on investments held within an ISA grow free of tax, which increasingly matters when allowances remain frozen. From April the 6th, 2027, the annual cash ISA deposit limit for those under 65 will drop to £12,000. But where you are holding a cash ISA, and these are long-term funds, you may not be taking full advantage of the tax benefits an investment ISA may offer. And also, don't forget about junior ISAs. Up to £9,000 can be saved tax-free each year for children or grandchildren. A tax-efficient way to build up savings for younger family members while also helping reduce the future size of your estate.
Do consider making pension contributions. Now, whilst we appreciate that from April 2027, pensions will be less attractive as a legacy asset, pensions still remain one of the most tax-efficient ways to save and build up wealth for retirement. So you can contribute up to £60,000 to a pension or 100% of your earnings if less. With allowances and tax bands frozen, building up tax-efficient savings is more important than ever. It helps you grow bigger pots more quickly, which later gives you the more options for funding retirement and redistributing wealth. And if you're not working, you can still contribute £2,880, which the government will top up to £3,600.
And also make use of this year's other allowances, including your personal savings allowance, the dividend allowance, and your capital gains tax annual exemption. While these have been reduced over the years, they are use it or lose it. And remember, spouses and civil partners can transfer assets between them to make full use of both sets of these allowances.
Check you're taking advantage of the exempt gifting allowances. So you have a £3,000 annual gifting exemption, which you can give each tax year either to one person or split across several. If you don't use it, you can carry it forward for a maximum of 1 year. There is also the small gifts allowance, which lets you give up to £250 per person per tax year to as many people as you like. The only restriction is that you cannot use this £250 allowance for anyone who also receives part of your £3,000 annual exemption or one of the wedding gifts exemptions, a separate gift to mark the special occasion. And this is £5,000 per child per parent, or £2,500 if you're the happy grandparent. And this can be combined with the £3,000 annual exemption. And of course, we've already seen the power of giving away surplus income. Just be mindful, you still need to fully cover your own day-to-day spending to claim this exemption.
And finally, charitable giving. If you donate through gift aid and are a higher rate taxpayer, you can claim relief at your marginal rate. It is an area many clients overlook, but it can be a meaningful part of both your tax planning and your legacy.
So those are the cases that we wanted to cover, and we have got some time to just pick up some questions that have been posted. So thank you those who have posted on our notice board. So let's just have a look. So Shalu, I can see that there's a theme here about questions asking about recent events that could be impacting what we've discussed, particularly around maybe the spring budget or the conflict in the Middle East. What are your thoughts?
Well, there was nothing material that was announced in the spring budget. Rachel Reeves still says that she's on track to remain within her fiscal rules, but we don't expect any changes or U-turns in any of the announcements that were made in the autumn budget last year. The Office of National Statistics has downgraded expected GDP growth, and there has been many a conversation about the cost of living as well.
And of
Rachel,
course,
sorry,
yeah, I was just going to say, and of course, the cost of living is under increasing pressure because of the conflict in the Middle East, with increased worry about inflation. Now, obviously, our investment team will be navigating these challenging times and making decisions on the portfolio. But, from a planning point of view, where there is depressed asset values, it could present an ideal time to be moving assets out of the estate with a view of potentially capturing smaller gains on those portfolios with a view of then getting the uplift of when those investments recover, taking place outside of the estate. Now, whether or not that's done through direct gifting or whether or not that's done through trust, Shalu, we've got some questions there over when you would do one over the other.
Mm-hmm. And gifting into trust versus direct gifting just means there's an element of control that's kept in some safeguarding as well. So that's when clients may consider gifting over trust versus direct gifting. Looking at the time, I think that's all we've got time for, but we will pick up any questions we've not been able to answer offline. But before we say goodbye, we just want to say that starting a conversation with a trusted advisor can really help bring clarity. It can give you the confidence in the decisions you're making and support open, meaningful discussions across the family.
And at Arbuthnot Nathan, we've spent many years helping clients navigate estate planning. We're here to make the technical side simpler, ease any concerns about getting it wrong, and support you in building a plan that feels right for you.
If you have any questions following this webinar, or you would like to arrange a complimentary wealth planning meeting, please contact your banker. And if you're not yet a client, please use the QR code to request a callback, and we can tell you more about the value of a banking relationship with Arbuthnot Latham. Thank you for your time this morning.
Yeah, good morning.